Good morning. It's Wednesday, the 18th of September, and this is Govindraj Ethiraj, headquartered and broadcasting and streaming from Mumbai, India's financial capital. The take. Companies often use the analogy of changing engines mid-air and during a flight to emphasize the challenges of keeping a company running and yet bringing about some fundamental transformations in its businesses or product or service offerings. Interestingly, Air India is faced with a problem that involves aircraft and a mid-air change, but actually it's inside the aircraft and not outside with the engine, so to speak. And this is proving difficult. Air India has set a target of November 12th for a full merger and integration with Air Vistara, the clearly superior product from the same owners, which is the Tatas. The internal benchmarking, as I understand, is clearly that the new product and service offerings of the combined entity should match that of Vistara, the smaller company, and not the larger one. Now, this is obviously a desirable and grand outcome to aim for, but not easy to execute. In my understanding, it's quite rare for a large organization to essentially become the smaller one it acquires. I'm also not really aware of any good examples from anywhere, though there must be. For this alone, the transition process will be interesting to watch. The managements obviously realize this and are churning staff furiously to make sure that there is more uniformity and age and experience, particularly at consumer-facing points. The latest news is that Air India has announced a $400 million refurbishment program to overhaul some 67 of its older aircraft, which will begin with 27 narrow-body Airbus A320 neoplanes, followed by 40 wide-body Boeing aircraft. The revamp could see a consistent three-cabin layout with business, premium economy and economy seatings for all aircraft like Vistara. The Economic Times quotes Air India as saying the first narrow-body aircraft, a single-aisle A320 Neo, went into the hangar on Monday and is expected to re-enter commercial service in December 2024. That's in about 3 months from now. It will join 8 recently delivered and operational Air India A320 Neo aircraft that already feature the upgraded cabin interiors and configuration. Some 3 to 4 aircraft could similarly get upgraded every month with a completion date of mid-2025, which is what the core report has estimated from interviews about that likely date for a fully integrated company and product that is uniform and, of course, glitch-free. But this is mostly the domestic product and involves the shorter haul aircraft. Upgrading the 40 wide-body aircraft, also where Air India gets the maximum flack for poor product, will start only in early 2025 and will obviously go on for some time. Air India's CEO Campbell Wilson is quoted as saying that over time, all the legacy wide-body aircraft will be retrofitted or refitted, and the comprehensive upgradation of Air India's physical product is an important component of the airline becoming a world-class one. Now, Vistara had said that its aircraft and passengers will be handled by Air India from the 12th of November. Air India's fleet currently comprises about 128 aircraft, while Vistara has about 70 aircraft. So you get the point about the larger one and the smaller one. And Air India, of course, flies to many lucrative international routes, while Vistara only flies to some. Now, handling all this change to stick to the mid-air engine and now cabin change analogy will require some very solid and consistent communication with all stakeholders, including, for example, Vistara passengers who will surely protest or complain when they land up in older Air India aircraft, particularly those that have not been refurbished. It may well be that changing engines while the aircraft is in flight might be actually easier in contrast to the challenge that lies ahead for Air India. And that brings us to the top stories and themes. The markets are on standby for a Fed rate cut today. Oil prices fall, as does wholesale price inflation. Gold imports jump 3 times in August thanks to lower duties and take trade deficit to a 10-month high. Steep import duties on edible oils will increase inflation. Why did the government do it now, and how badly will consumers be hit? And bank credit falls following a slowdown in personal, small business and agricultural segments.
This is the Core Report with Govindraj Ethiraj.
The stock markets are on standby. The stock markets continue to rise to newer highs, though they have once again resumed their steady trot or gallop rather than a raging bull charge, if you like such metaphors. On Tuesday, the 30-stock BSE Sensex rose about 91 points to 83,079, while the NSE Nifty 50 rose about 35 points to close at 25,418. So the market was mixed, as it's been on several days, with some sectors and stocks rising and others pulling back. Both the Nifty Small Cap 100 Index and the Nifty Mid Cap 100 Index were down marginally and almost surprisingly, given that they seem to stop at no station. The big trigger will be the US Fed rate cut this evening, if there is one. And there is, of course, considerable speculation on how much will it be, whether a quarter or a 0.5%. The answer to that, as I can see from everything that I have read and heard, no one seems to know. Whatever the number, it will likely change the nature of global flows for the coming months. And that is something institutional investors particularly would be watching very carefully. Oil prices slip down. So oil prices were subdued to lower on Tuesday as concerns about slipping demand continued to drive market sentiment. Like all other markets, oil traders are also waiting for the Federal Reserve's moves on Wednesday evening. Brent crude futures for November were quoting at about $72.27 or around $72 a barrel. Meanwhile, India's wholesale price index inflation eased to a 4-month low of 1.3% in August thanks to, you guessed it, falling costs of crude oil and then steel and cement. On the other hand, prices of food staples like potatoes and onions rose sharply, Reuters reported, adding that August wholesale inflation was lower than the 1.85% increase anticipated by economists in a Reuters poll and down from 2.04%, that's a little over 2% in July. More on food prices and edible oils specifically coming up. India's gold imports jump. India's merchandise exports fell about 9.3% to about $34.7 billion or close to $35 billion in August thanks to soft global demand and increasing logistics challenges. Imports, on the other hand, rose about 3.5% to about $64 billion during the month, leading to a trade deficit of about 29.6 or close to $30 billion, a 10-month high. The high import numbers were driven by gold, whose imports have risen 3 times to more than $10 billion in August, thanks to rising demand and, of course, lower import duties, which have kicked in at 6% versus the earlier 15% before June. Of course, gold comes into India anyway, and more of it is smuggled in when duties are high. A Reuters poll had quoted economists expecting India's August trade deficit to be $23 billion. So the gap, as you can see, is almost $7 billion. And the deficit stood at about $23 billion once again in the previous month, that's July. So gold imports in value terms were the highest since March 2021, when they had touched about $8.5 billion, according to Reuters. Exporters also told Reuters that India's good exports have been impacted by the escalating US-China trade war, rising freight costs, which have doubled in the past year to Europe and the US, besides a fall in global commodity prices. Brace for edible oil price inflation. Speaking of commodities, the government on Friday somewhat suddenly increased import duties on edible oils, both crude and refined. The new duties have gone from 0 to 20%, which is basic customs duty, as there was always a 5.5% cess. So on crude palm oil, crude soy, and crude sunflower oil, duty will be about 27.5%. On refined oils, the import duty will be about 35.7% versus the earlier about 13.7%. So why did this happen? For one, the domestic farmers, as we find out, were already asking for more protection as the imported oil was coming in at a price lower than even the minimum support price which the government pays. For example, in the case of soybean, former Agriculture Secretary Siraj Hussain said in an article in Money Control that prices were about 35% lower than that minimum support price and almost at par with prices 10 years ago. However, on the other hand, latest inflation figures for August 2024 released last week show that vegetable and pulses, for example, that's the inflation in them, were running at close to 11%, while edible oils and fats were at minus 0.86%, so less than 1% and negative at that. One of the very few components in the entire inflation basket that were negative and so low. Put differently, low edible oil inflation was what was keeping inflation from shooting further. Everyone, of course, knew this. So what's changed and what will be the impact? I reached out to Atul Chaturvedi, chairman of Shree Renuka Sugars and also chairman of the Asian Palm Oil Alliance. And I began by asking him how he was seeing the latest move by the governments to hike import duties.
So in fact, the industry had been demanding from the government that it's high time the duties are raised, because the trouble was soybean was selling much below minimum support prices. And that the fear was getting generated that going forward, you might have a situation that the farmer loses total interest in oilseed cultivation, and that is not good from sustainability angle as well. And as well as in terms of Atmanirbharta. So I thought, and I feel that the government has acted correctly and at the right time because you have a big soybean crop looming on the horizon, and we're now looking at something like 12.5 million tons of soybeans getting harvested this time around. And the rain gods have been Indian for the change. So in that scenario, I think it's appropriate, and there was no reason why edible oil should remain in a deflationary or a stationary mode. So I think it's a good sign.
Could you give us a sense on what is our current composition of consumption? I mean, how much is based on imports? How much domestically produced?
If we take our consumption at around 26 million tons annually, about 16 million tons or thereabouts is our import, and about 10 million tons is domestic availability, which includes mustard, soybean, groundnut, and rice bran, and cotton, all the oils put together. So our dependence on import is pretty high. And what we've also seen over the years is if India increases its duty, it's not that the whole increase in duty gets passed on to the domestic consumers. It doesn't happen that way. 20% increase in duty happens, then maybe about 10-12% will have to be borne by the Indian consumer, and the balance will actually be borne by the countries supplying edible oil to the country, to India, which is Indonesia, Malaysia, or maybe Latin America.
You're saying that basically countries that export to us, including in Southeast Asia, will have to reduce their prices to obviously supply to India more competitively. My analogous question is, how is it cheaper to produce it there than it is here? Because we're not talking about, let's say, I mean, it's not like, for example, light engineering from China and so on.
No, but India has been neglecting its oilseed scenario for a very, very long time. In fact, we were actually heavily compromised to edible oil security over the years. And that was largely because the government felt that importing may be much better option. But over the years, what has also happened is the Indian domestic consumption has actually gone up. So from a situation in the late 90s when India was only importing about 3 lakh tons of oil, we now have a situation that you're importing close to about 16 million tons, which means your edible oil security is heavily, heavily compromised. So I think it's a step in the right direction. We need more action on this front to ensure that dependence on imports is actually brought down below 50% level.
Right. And on impact to consumer, so you said that, let's say, because inbound prices will be lower, the net impact on consumers should be lower, about 10%. But that also seems high in a way because edible oil prices are the only one of the few elements of the inflation basket which have been keeping overall food inflation low. And that looks like it could change now. So how do you see that?
We are in a very catch-22 situation. You need high prices for your oil seeds, and your farmer is crying hoarse because his produce is getting sold below even the minimum support price. And on the other hand, we want to pamper our urban consumers by giving him very, very cheap oil. If you really look at the edible oil scenario in the last 30, 40 years, edible oil prices haven't really moved much. So which means we have neglected edible oil or oilseed sector big time. A partial correction of the aberration, and I hope results in more investment going into oilseed cultivation and farmers doing something about improving the productivity as well.
Just to come back to that earlier question, so why do you feel some of these other countries are able to produce at such low cost? Is it because they're not consuming it and therefore they are, in a way, getting rid of excess production? Or is there something in the way they produce, including agricultural productivity levels, which are different?
No, if you look at Southeast Asia, especially in the case of palm, the same is the story as far as other oilseeds are concerned. Take soya bean, for example. I was talking to a Brazilian farmer yesterday who was visiting us. I asked him, what is your average yield? He said, our average yield is close to about 4 tons per hectare. An Indian average is 1 ton per hectare. And in case of India, you are actually occupying 12 million hectares of land for soybean and producing just about 12 million tons of beans. So there is a big disconnect, but that probably is the case with most of our agri-produce. And we can go back into land size and better improvement in terms of seed and blah, blah, blah. So the whole problem.
Right. So now that the duties have been raised, do you see these duties staying on, or do you feel it's more a short to medium term measure?
Difficult to say because in India, we find by and large actions which are at times knee-jerk. But this time round, I think, or I hope and pray that it is not a knee-jerk reaction. And the other thing, the icing on the cake for the government would be that this would generate a hell of a lot of money by way of customs duty. Back of the envelope calculation is that the government might actually end up getting something like 45 to 50,000 crores as customs revenue. I hope and pray that they use this money for augmenting the oilseed production in the country. So this money will come handy. So at some stage, we will have to bite the bullet, and probably this is one beautiful moment.
Right. Mr. Chaturvedi, thank you so much for joining me.
Thank you. Thank you, Govind.
Bank credit is slowing. Bank credit growth fell by about 6 percentage points in July from a year earlier, driven by a slowdown in personal, agriculture, and small business segments, research reports and bankers told the Money Control. A September 10th Care Edge report showed that banks' lending growth has slowed to about 13.5% in July from about 19.5% in the year-ago period. Lending growth has slowed across all major sectors except industry in the period, with growth in personal loans slowing from about 30%, or rather 31%, to about 14%. So the decline was also driven by a slowdown in vehicle and unsecured loans impacted by the HDFC Bank merger, though partially offset by an increase in gold loans, according to that Care Edge report. And of course, if you've been following the core report closely, you would know about the jump in gold loans. Lending to agriculture was apparently down too. Money Control quoted analysts saying that the slowdown could be attributed to reduced credit expansion in the non-bank financial companies and trade sectors. Commercial real estate, however, grew faster than before. The report also highlighted that after reporting robust growth in 23-24, that's the last financial year, credit offtake is anticipated to moderate in this year, that's 24-25, thanks to a continued temperance in unsecured retail and slower corporate credit offtake. That was the Core Report with me, Govindraj Ethiraj. Do stay connected with more of our coverage at the Core. You can check out our website or sign up to our newsletter for our exclusive stories, one in-depth feature a day on www.thecore.in. Do also track us on LinkedIn, where we usually post synopses or extracts of our top stories and interviews. We would love your feedback on how we can make business more interesting and relevant, including, of course, India's vibrant manufacturing sector. So write to us at feedback@thecore.in, and thank you once again for listening.